Let's discuss GAAP use cases in detail for a global enterprise ERP implementation. Generally accepted accounting principles, that is GAAP, are a set of accounting standards and guidelines that are widely used in the United States for financial reporting purposes. Some key use cases for GAAP in a global enterprise ERP implementation include: 1. Financial statement preparation. GAAP provides a framework for preparing financial statements, including the balance sheet, income statement, and cash flow statement. Organizations must comply with GAAP to ensure that their financial statements accurately reflect their financial position, performance, and cash flows. This is important for businesses as it provides transparency to investors, creditors, and other stakeholders. For example, a business that follows GAAP standards will have a clear and accurate picture of its financial health, which can increase investor confidence and improve its creditworthiness. 2. Revenue recognition. GAAP provides guidelines for recognizing revenue in financial statements, including when to recognize revenue, how to measure revenue, and how to disclose revenue information. Organizations must comply with GAAP to ensure that their revenue is recognized in a consistent and accurate manner. This is important for businesses as it ensures that revenue is reported correctly, which can impact tax obligations and affect investor decisions. For example, if a business recognizes revenue too early, it may inflate its financial results and mislead investors. 3. Inventory valuation. GAAP provides guidelines for valuing inventory, including how to measure inventory costs and how to determine the lower of cost or market value. Organizations must comply with GAAP to ensure that their inventory is valued correctly and that the value is reflected in their financial statements. This is important for businesses as inventory is often a significant asset, and its accurate valuation is crucial for financial reporting. For example, if a business overvalues its inventory, it may appear more profitable than it actually is. 4. Depreciation and amortization. GAAP provides guidelines for depreciating and amortizing fixed assets and intangible assets, including how to calculate depreciation and amortization, and how to select the appropriate method. Organizations must comply with GAAP to ensure that their fixed and intangible assets are depreciated and amortized correctly. This is important for businesses as it helps to accurately reflect the value of these assets over time, which can impact financial reporting and decision-making. For example, if a business does not depreciate its assets properly, it may overstate its profits and mislead investors. 5. Leases. GAAP provides guidelines for accounting for leases, including how to classify leases as operating or capital leases, how to recognize lease payments, and how to disclose lease information. Organizations must comply with GAAP to ensure that their lease obligations are accounted for correctly. This is important for businesses as leases can have a significant impact on financial reporting and decision-making. For example, if a business fails to properly account for lease obligations, it may underestimate its liabilities and mislead investors. 6. Financial instruments. GAAP provides guidelines for accounting for financial instruments, including how to recognize, measure, and disclose information about financial instruments such as loans, bonds, and stocks. Organizations must comply with GAAP to ensure that their financial instruments are accounted for correctly. This is important for businesses as financial instruments can have a significant impact on financial reporting and decision-making. For example, if a business fails to properly account for financial instruments, it may misstate its financial position and mislead investors. 7. Asset impairment. GAAP provides guidelines for recognizing and measuring asset impairments, including how to determine when an asset is impaired and how to calculate the impairment loss. Organizations must comply with GAAP to ensure that their assets are valued correctly and that any impairments are recognized in a timely manner. This is important for businesses as it helps to accurately reflect the value of assets over time, which can impact financial reporting and decision-making. For example, if a business fails to recognize an impairment loss, it may overstate its profits and mislead investors. 8. Taxes. GAAP provides guidelines for accounting for income taxes, including how to recognize and measure deferred tax assets and liabilities, how to determine tax provisions, and how to disclose tax information. Organizations must comply with GAAP to ensure that their tax obligations and liabilities are accounted for correctly. This is important for businesses as taxes can have a significant impact on financial reporting and decision-making. For example, if a business fails to properly account for tax obligations, it may underestimate its liabilities and mislead investors. 9. Earnings per share. GAAP provides guidelines for calculating and disclosing earnings per share, including how to determine the numerator and denominator of the earnings per share calculation, and how to disclose information about stock options, warrants, and other dilutive securities. Organizations must comply with GAAP to ensure that their earnings per share calculation is accurate and transparent. This is important for businesses as earnings per share is a key metric used by investors to evaluate a company's financial performance. For example, if a business fails to properly disclose information about dilutive securities, it may mislead investors about the true value of their shares. Segment reporting. GAAP provides guidelines for reporting financial information by segment, including how to determine reportable segments, how to measure segment revenue and profit, and how to disclose segment information. Organizations must comply with GAAP to ensure that their segment reporting is accurate and meaningful. This is important for businesses as segment reporting provides investors with a clearer understanding of the financial performance of different business units within an organization. For example, if a business fails to properly report segment information, it may mislead investors about the true financial performance of the organization. Stock-based compensation. GAAP provides guidelines for accounting for stock-based compensation, including how to recognize and measure the expense associated with stock options, stock warrants, and restricted stock awards, and how to disclose information about stock-based compensation. Organizations must comply with GAAP to ensure that their stock-based compensation is accounted for correctly. This is important for businesses as stock-based compensation can have a significant impact on financial reporting and decision-making. For example, if a business fails to properly account for stock-based compensation, it may overstate its profits and mislead investors. Fair value measurements. GAAP provides guidelines for measuring fair value, including how to determine the fair value of assets and liabilities, how to recognize fair value gains and losses, and how to disclose fair value information. Organizations must comply with GAAP to ensure that their fair value measurements are accurate and meaningful. This is important for businesses as fair value measurements are often used to value financial instruments and other assets and liabilities, which can impact financial reporting and decision-making. For example, if a business fails to properly measure the fair value of its assets and liabilities, it may misstate its financial position and mislead investors. In conclusion, GAAP provides a comprehensive set of guidelines and standards that organizations must comply with to produce accurate and meaningful financial statements. A global enterprise ERP implementation must be designed to support GAAP requirements, provide adequate controls and reporting capabilities, and ensure that financial information is accurate and compliant with GAAP. Organizations that comply with GAAP are better positioned to meet the needs of investors, stakeholders, and regulators, and to make informed decisions based on accurate and reliable financial information. We really thank you for your time spent on this session.